Assalamualaikum and selamat sejahtera to Madam Bushra and my fellow colleague. We are from Group 2. The topic for our presentation is financial ratio analysis. As you guys may be aware, we were given the option to choose any company from the Bursa listing and analyze the chosen company based on its audited financial statement for the past 3 years. What is financial ratio actually? To simplify, financial ratio is the analysis that is useful technique to measure, compare and evaluate the financial condition and performance of a customer. Ratio analysis also enables a credit manager to spot trends in a customer's financial performance and to compare its performance and financial condition with the average performance of similar business in the same industry. We choose this company because Top Glove is embarking into a world of possibilities with a clear purpose to inspire all of our people to be their best physically, mentally and socially. For your information, Top Glove is one of the world's largest manufacturer of natural rubber gloves, are exported to more 195 countries. The company is headquartered in Malaysia for healthcare providers, production of rubber and nitrile glove manufacturers and consumers. Top Glove was listed on the Bursa Malaysia in August 2001. In the span of a year, Top Glove Corporation Berhad listing was promoted from the second board to the main board on 16 May 2002. Also, the company was formed on 9 of July 1991 in Shah Alam, Selangor by Wee Chai Lim and Siu B Tong.
Okay, now I will present about the strength and weakness of the Top Glove. From the annual report of the year 2019 till now 2031, I believe Top Glove have the strength to deliver both long-term value and growth for their multiple stakeholders. They also maintain best level for inventory to meet the delivery and product. Top Glove also consistently engage with customer to understand their needs and understand about market trend. They also have strength about develop feedback system for customer to identify and overcome product and service shortcoming. When Top Glove moved toward digitalization to minimize workload and human error in operation management, they also recruit suitable and quality M&A talent while retaining and continuing to train the right talent. They also closely monitor M&A process and integration post-acquisition to ensure synergy are achieved. Lastly, they also introduce long-term incentive plan with achievable goal to motivate the acquisition team to actively seek opportunities and achieve synergy while ensuring alignment of long-term objective between employee and stakeholder to prevent short-termism. Okay, as a big company, Top Glove Corporation also have a weakness. By extending business global footprint, it will expose the group to sovereign risk, compliance risk, political and economic uncertainties such as a change in government law regulation and fiscal policy of the host country. With the group initiative toward automation and digitalization, it increased the complexity on integrating the production at factories with the information management system. The group business may be vulnerable to security breach to key system, asset and facility resulting from cyber attack and sabotage. Potential disruption to operational system or disruption of facility from such security breach can adversely affect the group reputation, business and financial result.
Next, we would like to present the summary of the financial statement which will be applied in the financial ratio analysis that will be presented later. For your information, we have analyzed the summary based on the company group financial statements. You may refer to the table presented below, which is table 1, 2 and 3 for your reference. The table shows the summary of the financial statement for the year 2019, 2020 and 2021. What is liquidity ratio? In accounting, the term liquidity is defined as the ability of a company to meet its financial obligation as they come due. The liquidity ratio then is a computation that is used to measure a company's ability to pay its short-term debts. There are three common calculations that fall under the category of liquidity ratios. The current ratio is the most liberal of the three. It is followed by the quick ratio and the cash ratio. These three ratios are often grouped together by financial analysis when they attempting to accurately measure the liquidity of a company. However, for Top Glove, we only use two liquidity ratio, which is current ratio and quick ratio. I would like to explain further details on current ratio and quick ratio in the next slide. The current ratio is a liquidity and efficiency ratio that measures a firm's ability to pay off its short-term liabilities with its current asset. The current ratio is an important measure of liquidity because short-term liabilities are due within the next year. Now let's proceed to the formula of the current ratio. The formula for the current ratio is current asset divided by current liabilities. The table shows the result of the current ratio from the year 2019 to 2021. The result for the 2019 is 0.96 times, while result for 2020 is 2.01 times, and result for year 2021 is 1.98 times. The current ratio of Top Glove for the years 2019, 2020 and 2021 are as per graph 1. Although the ratio is slightly decreased for the year 2019, the result for the year 2020 and 2021 is greater than 1, which indicates that year is well positioned to cover its current or short-term liabilities without any issue. In theory, the higher the current ratio, the more capable of company is paying its obligations. The quick ratio or acid test ratio is a liquidity ratio that measures the ability of a company to pay its current liabilities when they come due with only liquid asset. The quick ratio measures the company capacity to pay its current liabilities without needing to sell its inventory or obtain additional financing. The quick ratio is considered a more conservative measure than the current ratio, which includes all current assets as coverage for current liabilities. Meanwhile, the quick ratio formula is current asset divided by current liabilities. Table 2 shows the analysis of the quick ratio based on the past 3 years audited financial statement year 2019 till 2021. 2019 quick ratio result is 0.57, 2022 is 1.76 and 2021 is 1.65. As we already calculated all the details of the past 3 years quick ratio, allow me to explain the analysis of the graph provided below. For your further understanding, as per graph 2, the result for both years 2020 and 2021 is greater than 1, which indicates that the year is well positioned to cover its current or short-term liabilities without any issues. However, the ratio result for year 2019 is quite low, and this shows that year 2019 is not well positioned to cover its current or short-term liabilities, and more likely the company will struggle with paying debts. Thus, company that has quick ratio of less than 1 may not be able to fully pay off its current liabilities in short term, while a company having a quick ratio higher than 1 can instantly get rid of its current liabilities.
What is leverage ratio? Subsequent to the recent presentation, I would like to explain to you guys on leverage ratio. Alright, what is leverage ratio? A leverage ratio is any kind of financial ratio that indicate the level of the debt incurred by a business entity against several other accounts in the balance sheet, income statement, or cash flow statement. This ratio provides an indicator of how the company asset and business operation are financed using debt or equity. Below is the illustration of the two common leverage ratio, debt equity and debt capital. Average ratio are constant of debt ratio, debt equity ratio, and time interest ratio. First, let me explain the definition of each of the leverage ratio component before we proceed to the calculation and our result. Debt ratio. The debt ratio quantified how leveraged a company is, and a company degree of leverage is often the measure of risk. When the debt ratio is high, the company has a lot of debt relative to its asset. It is thus carrying a bigger burden in the sense of the principal and interest. Payment take a significant amount of the company's cash flow, and a hiccup in financial performance or a risk in interest rate could result in default. When the debt ratio is low, principal and interest payment don't command suck a large portion of the company cash flow, and the company is not as sensitive to change in business or interest rate from the perspective. However, a low debt ratio may also indicate that the company has an opportunity to use leverage as a means of responsibility growing the business that is not taking advantage of. Okay, next. Debt equity ratio. The debt equity ratio is an important metric in finance that measures the financial leverage of the company and evaluate the extent to which it can cover the debt. It is calculated by divide the total liability by the shareholder equity of the company. Additional, a higher debt equity ratio means that the company has been aggressive in its growth and is using more debt financing than equity financing. A lower debt equity ratio suggests the opposite, that the company is using less debt and is funded more by shareholder equity. Third, time interest earn ratio. The time interest earn ratio, sometimes called the interest coverage ratio, is a coverage ratio that measures the proportionate amount of income that can be used to cover interest expenses in the future. In some aspects, the time interest ratio is considered a solvency ratio because it measures a firm's ability to make interest and debt service payment. Since these interest payments are usually made on a long-term basis, they are often treated as ongoing fixed expenses. As with most fixed expenses, if the company cannot make the payment, it could go bankrupt and cease to exist. Thus, this ratio could be considered a solvency ratio. Table 3 shows the result of the leverage ratio for the past 3 years. Now, we have understand what is leverage ratio. Let's proceed to the calculate of the top growth leverage ratio and its result. You may refer to graph number 3 for the further understanding. I will explain each top growth leverage ratio based on the graph 3 as shown in the slide presentation. The debt equity ratio will be in the green color, time interest in yellow color, and the debt ratio will be in the red color. Debt ratio for year 2019, 2020, and 2021. From the year 2019 till 2021, show the debt ratio for the 3 years are lower than 1.0. This is show that the company risk is lower and they are able to lower the amount of the debt in the financial company structure or vice versa. Debt equity ratio for year 2019, 2020, and 2021. From year 2019 till 2021, show the debt equity ratio decreased from the past 3 years. This is show that the company risk is lower than a lower debt equity ratio, may indicate the top growth is not take an advantage for the debt financial to expand. Time interest earned for 2019, 2020, and 2021. As for the time interest earned for 2019, 2020, and 2021, it shows that the year 2019 has the highest ratio than 2020 and 2021. It means the higher ratio indicate that the firm can meet loan charges and lower risk of the default. However, the time interest earned for the year 2020 and 2021 are slightly increased. Thus, this indicates that the company has lower ability to pay the interest.
Activity ratio. Activity ratio assesses how effectively a company is able to generate revenue in form of cash and sales based on its asset, liability, and capital shares account. It's focused on how well a company managed to generate revenue and increase their profit. That is for activity ratio, which is inventory turnover ratio, average collection period, total asset turnover, and total receivable turnover. Inventory turnover. The ratio measures the extent of the efficiency of a firm in using its resource to generate sales. One of the functions is to manage its investment in inventory efficiency. Total asset turnover. The asset turnover ratio measures the value of a company's sales or revenue relative to the value of its asset. The asset turnover ratio can be used as an indicator of the efficiency with which a company is using its asset to generate revenue. The higher asset turnover ratio, the more efficient a company is at generating. Non-current asset turnover. It shows the relation between a company's net sales revenue to the net book value of its total non-current asset. The ratio helps to determine the proficiency with which a company utilizes all its non-current assets. Its proof useful determining how such assets are used optimally to generate earnings. Total asset turnover is increased from 2019 to 2021. Although average collection period indicates that the organization collects the payments faster. The company efficiency is generating sales or revenue from its asset base. Total asset turnover is increased from 2019 to 2021. The company efficiency is generating sales or revenue from its asset base.
Hi everyone, I'm Muhammad Fazli bin Muhammad Saleh, and I will explain about profitability ratio. Profitability ratio measure how effectively the firm uses its assets to make profits. They show the profits earned for every dollar of sale made or the profits earned per dollar of investment in assets. This ratio also indicates the firm's efficiency in controlling costs and its pricing policy. Profitability ratio are one of the most popular metrics used in financial analysis. They generally fall into the two categories. The first one is margin ratio, and the second one is return ratio. Margin ratio give insight from several different angles on a company ability to turn sales into a profit. And then return ratio offers several different ways to examine how well a company generates a return for its shareholder. Profitability ratio commonly analyzed by firm gross profit margin, operating profit margin, net profit margin, return on assets, and return on equity. Please refer to the table 5 and graph 5 as attached in the slide presentation for your reference. Gross profit margin. Different profit margin are used to measure companies' profitability and various cost level of inquiry, including gross margin, operation margin, pre-tax margin, and net profit margin. The margin shrink as layers of additional costs are taken into consideration, such as the COGS, operating expenses, and taxes. Second one is operating profit margin. Operating profit is derived after deducting all costs and expenses, excluding intercharges and taxes from the sales figure. This is the true made from the operation of the company. Of course, the highest the operating profit margin highest is the profitability of the company. Next is net profit margin. Generally, the ratio is not useful for companies making losses because they do not have a profits. This ratio also indicates the pricing strategy adopted by a firm. Net income available to common stakeholder refer to the net profit after tax minus the preference dividend. If any, this is the actual profit to ordinary stakeholders. If there is no preference dividend, then the net income available to common stakeholder is net profit after sales. Net profit after sale is derived after deducting all costs and expenses, including interest and taxes. Of course, if the firm's operating expenses are high, the net profit margin will be low. Next, return on asset. Return on assets, ROA, which is also known as return on investment, which is ROI. It indicates the management ability to make profits from the firm investment in assets. ROA is net income divided by total assets. The more assets a company has amassed, the more sales and potential profit the company may generate. As economies of scale help lower costs and improve margins, returns may grow at a faster rate than assets, ultimately increasing ROA. Lastly, the last profitability ratio that I will explain is for the return on equity. Return on equity, ROE, measures the profit earned by the common stakeholder from their investment in the company. The higher the return on equity, the better the return for the shareholders. Generally, high growth firm will have higher ROE. ROE is a key of ratio for shareholder as it's a measure company's ability to earn a return on its equity investments. ROE is calculated as net income divided by shareholders' equity may increase without additional equity investment. The ratio can rise due to highest net income being generated from a larger assets base funded with debt.
For the recommendation, Top Glove maybe can improve its liquidity ratio by raising the value of its current asset, reducing liability by paying off debt or negotiating delay payment to creditor. The average collection period indicates the effectiveness of a firm account receivable management practice. However, for the year 2019 and 2030, for Top Glove is quite long. Thus, some improvements need to be implemented, such as improving its average collection period in a few ways, such as set stricter credit term, limiting the number of days of an invoice alone to be outstanding, and also offer pricing discount for yearly payment. It is very important for the company that heavily rely on their receivable when it comes to their cash flow. For the average collection period analysis, we can conclude that Top Glove managed to collect the payment more efficiently. However, this may mean that the company's creditors are too strict. Customers who don't find their creditors' terms very friendly may choose to seek supplier or service provider with more lenient payment terms. Top Glove should discuss with the customer and should offer them a few benefits if they still want to remain strict on their credit term. Considering the total asset turnover for Top Glove's company that is slightly decreased, Top Glove should try attempt to rise a low asset turnover ratio by stocking its sale with highly items that can be sold, replenishing their inventory only when necessary, and augmenting its hours of operation to increase customer foot traffic and spike sale. Due to slight decrease of the net profit in year 2031, Top Glove may gain a competitive advantage in general by increasing the sale or reducing expense or both. Reducing both of sale and expenses. They also could try boosting the sale, but it often involves spending more money to do so, which is equal to the greater cost. However, cutting too many costs also lead to undesirable outcome, including losing skilled worker, shifting to inferior material, or other losses in quality. To reduce the cost of production without sacrificing quality, the best option for the Top Glove Corporation is for many business expansion. We now have reached to the end of our presentation. After so much deliberation on the final ratio analysis, we would like to end our presentation with the conclusion that we have made throughout this analysis. After analysis of the final performance of Top Glove Corporation Berhad for the period of 3 years from 2019 to 2031, the study revealed that the overall financial performance of the company is improving gradually. However, it needs to minimize the operating expenses to get higher net profit. In order to carry on the business successfully, the company should improve its liquidity and solvency position in the long run. That's all for our presentation. Thank you for watching, and Assalamualaikum.